Welcome to Real Cash Flow, the only show that takes you full circle with your money, covering stocks, bonds, commodities, currencies, crypto, insurance, and real estate. I'm your host, Andrew Michael Arroyo. Let's get started. In our inaugural show, I want to give you some context about who we are, why we're doing the show, and what you can expect as a listener. First and foremost, remember, this information is educational and entertaining. It is not meant to be financial or legal or tax advice. I don't know about you, but I am stretched for time these days and jumping from podcast to podcast, trying to figure out what I should do with my real estate, what I should do with my stocks, what I should do with my crypto. I'm overwhelmed. I wanted one show where I could come to one place to make decisions what to do with my money. And that's what Real Cash Flow is all about. It's analyzing the broad market at large. We're looking at stocks. We're looking at bonds. We're looking at commodities. We're looking at crypto. We're looking at insurance. We're looking at real estate. We're looking at the full gamut to make educated decisions on what's hot and what's not for your money right now. This is the one and only show where you can listen for 45 minutes and get a macro view of all the different markets with sound decision making on where to place your dollars right here and right now. Looking for the big trends, then you can drill down into those specific strategies and decide where to park those dollars. So without further ado, let's launch our first inaugural episode. So let's dive in. Today I'm joined by Gary Giffin and Jason Riehl. These are two colleagues of mine that we have spent the years together going through the ups and downs, the cycles, and we find ourselves in a place that scratches a lot of heads. Many people are looking at the markets going, I don't get it. The Fed's moved the interest rates up aggressively. Real estate prices have not come down, at least not in residential, but have got hammered in commercial. The stock market is not supposed to continue to go up in the midst of high interest rates and inflation, yet it continues to hold, at least for now. And we have a space like crypto that's come in and stole the show until recently, where finally we have things like precious metals rallying. So a lot of people are wondering, what do I do with my money? Do I just park my money in the bank and get the 5%? Because I don't have to do anything. Or do I step out in faith into some of these more aggressive asset classes and take some risk? Is it risk on or risk off? Jay, what are your thoughts?
Risk on with a steel stomach based on what's going on around you. In the immediate moment, I think it's a time for some pause as far as the market's concerned, as we've taken a little dip here. So being aggressive isn't something to be right now in any arena.
So precious metals have been absolutely red hot for many, like myself, who have been waiting years for this kind of breakout. It has arrived. Here we are, spring of 2024, and we've seen a move just in this last few weeks to the upside in both gold, silver. You're seeing palladium and platinum follow, but primarily in gold and silver. And you're seeing a shift. There's obviously a cataclysmic shift out of other assets like technology and stocks into precious metals. So Gary, a few years ago, I feel like I converted you to a gold bug, and here you are today enjoying this run. What are your thoughts as you're watching a large position for you and your family pay off?
Yeah, thanks for the conversion, by the way. Andrew, you didn't tell me to buy it, but you did hint that it would be a good idea. This is a couple of years ago. We had that conversation. And I believe my wife was in on that conversation. We were talking over Zoom, or it was a speakerphone. And at that time, I had a 401k from a previous executive, I could call it executive job, that was kind of sitting there with stocks going up and down, and I didn't feel comfortable with it. So I asked you, hey, what do you like? What's your favorite commodity besides stocks? And you mentioned gold and silver. Had some other conversations with some local gold and silver outlets here in San Diego, and we decided to take a good portion of that retirement fund, which some of it is in real estate, which it should be. If I'm selling real estate, I better own some, and I do with you and several agents. But the gold and silver was intriguing because at that time, people were talking, and I think at that time, silver was in the teens, trying to push up to 20, and gold at that time was 1700, trying to push up to 1800 an ounce. So if you look at it, the charts today, and you can actually, I know you will probably post some charts. It's breaking records every day during this past week. So it's just gone bonkers. So if you try and if you're going to buy an ounce of gold now, and Jason, if you have any gold in your mouth, you may want to pull some teeth, go out and see what you can get for that. That ounce tooth is worth about $2,400, somewhere around there, $2,400. Does that sound right to you, Andrew?
That's right. That's the spot price today. And to Gary's point, what we're seeing, and we will post this in the show notes, some links for everybody, is essentially the volume increase, right? So when you're looking at trading and you're looking at moves that would be a momentum play, you're really looking for a shift in assets coming from something like the stock market into the commodity market. In this case, because of what's going on in the Middle East, because of the fear, because of people just desiring those hard assets, you're seeing tremendous volume. I mean, on average, on say the dailies, you might see 20 million trade in the spot markets or in the futures markets. Now we're seeing 30 million, 40 million on a daily basis. On the weeklies, a huge spike in weeklies might be at 100 million. And just last week, we're at 150 million contracts trading. And so those are the indicators that we look for. We'll get a little deeper into the technicals with Jason Riehl here in a minute. Me and him for more than a decade have really poured ourselves into the education to the markers of what those technical breakouts look like and good entry prices, good exit prices. Again, take all that with your own analysis. The way that we share our information is educational and through some entertainment to keep it lighthearted, but ultimately you want to make your own decisions and consult with your own advisors. But what's your thoughts, Jay, as you see this technical breakout? I mean, this is a long time coming. I'm going to put up on the screen here the monthly. I mean, you're looking at a multi-year breakout. The last high was, post-COVID, that reaction after that dip in March and then that spring back in the summer where you saw the meme stocks do their thing. Gold followed, hit a high of 2,089. And then it sat there for 4 years in a trading range. And finally, here we are, April of 2024, watching it do its major breakout. If you look at that historical chart going back 20 years, I mean, you look in 2011 when it was in its glory days, and it has a massive cup and handle. I mean, from, summer 2011 to summer 2020, you've got your cup and you've got your pullback of a handle, bottoming out there in late 2022 with the rest of the stock market in October at 1618. And now you've got this breakout above the 2100 mark. And boy, what a force to be reckoned with. I mean, 200 points in a matter of weeks.
Right. And the most impressive thing is, I guess, just the decade-long base. I guess they say longer the base, the higher in space. So you've got, and even the volume in 2019, 2020, when it was building the right side of this, and you might even call that late 19 and 20 a little handle there in that cup that started in 2011, because you see the big volume surge, which is even greater than what we have going on today. But at this point, everybody's in the money. So as stocks get price discovery, to meaning they go to places where they've never been before, you can have more, I don't know, more faith or more gumption to hold on to your position or to be more confident, just because no reason to sell when you're in the money. You have no overhead resistance, which would be nobody's purchased gold over $2,500 yet. So it's a good place as far as the position's concerned. The other side of the coin is, why is gold breaking out to new highs? Usually it's something's going on that's not that great. So that's the other side of the coin. But if you have the ability and the foresight to hold on to some of that, put some of your assets in gold, at least protects you from things that might go sideways in the other asset classes. And obviously, people are doing it now on a large scale because with the volume action that you were talking about, Andrew, we like to call that the big boys footprints. We're the small guys. We can't move stocks or metals or commodities like the institutions can, or in this case, it would be the federal banks. But you can see that it's happening based on the volume expansion as price expands at the same time. So all positive as far as gold's concerned. Technical action, it's a place you want to be.
Yeah. And for somebody just getting started, because we love introducing commodities and precious metals, currencies to individuals that have been stuck in the stock and bond world their entire investment career. Both myself and Jason, longtime members of stockcharts.com. Big shout out to that community. It has incredible education. For years, me and Jason used to sit on a Saturday afternoon and review charts and spend an hour with a friend diving into learning these technicals. And this is years later, and it pays off. It pays off in big rewards when you've paid attention and done your education. So I want to point you in that direction. For context, for people that know our network as a real estate network and say, here you are on a podcast sharing about, gold and silver and commodities and crypto and all these other asset classes. What's the background? What's the context? How did you get into here from real estate? And the background is simple. As a matter of fact, I credit a mentor of mine who was a very prominent trader and fund manager in the early 80s. His name was Al Weiss. He was featured in the books that Jack Schwager wrote, Market Wizards, New Market Wizards. If you've never checked those out, again, I'll put the links in the show notes. I'm a big fan of Jack Schwager. He interviews top traders and fund managers. Think Jim Rogers, think George Soros, think Paul Tudor Jones, individuals like that, and really gets to the nuts and bolts of their system. Now, I randomly, by God's grace, get a phone call one day by this guy named Al, and within about 5 minutes of speaking with him, I knew exactly who I was talking to, and I called him out right away. I said, "Are you the same Al Weiss featured Market Wizards?" He said, "Yes. How did you know that?" And I said, "Well, I've done a lot of research, and you've got an incredible track record." He had over a 10-year track record running a fund in commodities. And this is post the 70s. This is in the 80s. And he had returned, over 50% after fees to his investors. And we made an exchange. I would teach him everything I knew about real estate. He would teach me everything he knew about commodities and currencies and the markets in general. And this is going back about 20 years. Unfortunately, Al has passed away now, but in his honor and giving him credit, he taught me the mechanics and the patterns. He was a technical trader, didn't pay too much in the stock market, he paid attention to fundamentals. But when it came down to commodities, him and his mentor at Dakota would call them fundamentals, not fundamentals, but fundamentals. Mm-hmm. Because at the end of the day, he said, you're charting human psychology. That's all that's happening here. So the supply demand curves come and go. But what you're looking at when you're looking at these charts and studying is you're watching paint dry. It's not the most interesting thing. It can get quite boring. But I'll tell you what is interesting when you see money pouring into your account. And so our goal with the show, sharing the nuts, the bolts, the wisdom, is to start people off, to start to educate them, to broaden their mind beyond the stocks, beyond the bonds. We'll talk a lot about real estate because everybody on the show has experience in real estate. And starting to move your investments through self-directed plans into broader asset classes so you can participate in these rallies. So Jay, I want to get back to this precious metals, and I want to pull up some leading indicators because anytime anybody has a big gain, like so many people have right now, and this could be in crypto too. We'll get to crypto. We're going to dedicate an episode coming up here to crypto because that's had an incredible recovery. It is rivaling that safe haven, gold and silver, for that store of wealth. But crypto seems to be tied to the NASDAQ. And when the NASDAQ goes, crypto goes. And precious metals, on the other hand, tend to stand alone. And so we're going to focus on that right now because it's making these multi-level highs. But I want to talk about relative strength real quick, Jay, because It's such an easy indicator to pay attention to. And relative strength, it goes from 0 to 100. RSI is the acronym. And typically, stocks or commodities that are moving in a trading range are going to be at 50, right in the middle. But once you break over 70, that shows tremendous strength or momentum. And once you break down under 30, that shows typically some overselling. But I want to talk to you about the weekly chart. That's my favorite chart, Jay, and the one I've always studied and the one I was taught by my mentor to study and pay attention to the closest. But we're seeing on this breakout, we're 1, 2, 3, 4, 5, 6, 7 weeks into this breakout. We've seen the breakout into the relative strength above 70. From your technical analysis, what do we need to be paying attention to forecast a potential rollover and pullback in these prices to either get an entry position for people that are not in, or consideration to take some risk off and take some money off the table?
Right. Initially, like you stated, it's as it moves over 70, the relative strength of the price action of this, whatever stock or commodity you're looking at, is increasing. The momentum's increasing based on its own price and current action and previous recent action. As far as a pullback, or if you're looking for another entry, or what I like to say is as stocks or commodities or anything that you're charting, things move up and then they pause. It's like an inhale and an exhale. So we've had a big exhale, so you need to inhale and regather your steam. So one trigger would obviously be if it moves back below 70. I mean, it's currently at 78 at this weekly chart we're looking at on the gold. So it can stay elevated for a while, but once it moves under 70 again, comes back into the less overbought or below where it is now, that can often trigger some selling, because people technically will look at that to close positions for the shorter term or the tactical traders. As long as it remains above 50. So if we're between 70 and 50, you don't want to see it break below 50, but the closer it gets to 50 is a place to make some additions if you're just focusing on the RSI indicator. There's other things you could use to help, like moving averages is another way to look in combination at what moving average is it pulling back to, and is it the RSI pulled back at the same time. So initial triggers are when it falls back below 70. That would mean that there's definitely less buying pressure and some sellers coming into the market.
Now, Gary, when you look at a chart like this, what does it look like to you?
Oh, for me, it's excitement, and it's when do I take what I've earned here in the past couple years? When do I sell, take some profit, and then buy it back? Silver, from what I understand, and talking to other investors, even Robert Kiyosaki, who I've followed for years, when I started into real estate, I got his books. He's into silver, not only just silver itself, but silver mines, gold mines. And silver seems to be a commodity and I used to be in the electronics field years ago, and worked with engineers and designing phones, mics, joysticks, things like that. But all of those items, if you take it apart and look inside, has silver in it or other precious metals. But I would imagine everybody's hoping that that's going to hit the 50 mark. I thought that was going to happen last December. It's slowly coming up now, from the low 20s. Now, looking at the chart, almost breaking 30. And I would imagine, with things happening here in the world, with wars and rumors of wars, that gold and silver will break some more highs. So, gosh, I just don't know when the time would be to take my profit and then watch for it to come back down, or maybe it doesn't. So that's a tough one, right? I'm sure you've got your take on that.
And that's the real world questions. That's exactly why we're producing this show, because for years we have traded the markets, studied the markets, educated lightly internally in our companies to the markets, but never opened it to the general public to share our system, how we're doing what we're doing. And rather than keep it to ourselves, we believe the right thing to do is to share the techniques. And again, everybody needs to make their own decisions here. At the end of the day, as we give that disclaimer, as we start every show, right, when it comes down to the financial, the tax, legal advice, you have to make your own decisions. But we're going to give you what has proven to be effective in our trading methods, in our investing methods. I think it's a good time to really discuss the difference between trading and investing, because silver and gold is a prime example, a good analogy to look at when you look at trading and investing. Most people invest in gold. Most of the traders I know trade silver. And not that they don't correlate and they don't run with one another, but the best analogy I would give is silver's like gold's erratic, manic, depressive little brother. And silver moves up and down and all around and doesn't follow the same chart patterns and stability that gold does. There's a couple of reasons for that. For one, there's a limited amount of silver that's out there. And we all know the stories. If you've done your research, you've read about the history of silver, where you've had families like the Hunt family corner silver markets, or certain investment banks have a tremendous amount of silver holdings. And there's a lot of nonsense, in my opinion, that's on the internet about how this is a controlled market and it's rigged. Not the case. It's just it's not as liquid of a market as gold, and therefore it's going to get the volatility. Now, with that, it presents tremendous opportunities because there is such volatility. And if you look at, for example, the daily and weekly charts of silver and you compare them with gold, silver has not broken out from that multi-year high yet. It's right on the cusp right now. Again, this is April 2024. But if we look at even a, say, 10-year chart, we saw that high right about 30, spot prices of just at 30 after COVID. And here we are at 28.72 this week. So we still have not seen that breakout and then another 10% run. In 2011, when there was that supply demand that we saw out of China, the thing rallied up to 50, and everybody's waiting for that level of a breakout. And again, back to the volume. If you study the volume of 2011 and you see what was happening there, you were seeing on a monthly basis hundreds of millions of contracts on a monthly basis trading hands. And even in COVID, we saw 2 months of that, a couple hundred million, as high as 350 million. That's what pushed that back up to 2029 and set kind of a new ceiling. But right now, you're just starting to see the volume pick up above 100 million towards 150 million. So when we look at sell signals, to answer your question, Gary, what I look for personally is I look for what I refer to as loud signals, unusual volume that will not be sustained. And in this case, if I saw 300 million, 400 million, 500 million, if I saw 1 billion contracts trade, I would know temporarily we probably have what they refer to in technical analysis as some form of a pintail, where it's just going to pop and then it's going to drop. It doesn't mean the run's over, but it very well may have seen its day for the time being. So with that, I trade around the position, like Gary mentioned. I'll take a long-term position. For example, let's say I had $100,000 I wanted to put into the precious metals camp. First, I'm going to take a look at what are the precious metals I want to invest in. I've got palladium, I've got platinum, I've got gold, I've got silver, I've got copper. In my case, if I'm looking for the store of wealth, I'm looking for a hedge against what's going on in the world, well, gold and silver are predominantly going to be those plays. Palladium and platinum have a lot more to do with industrial use, and palladium specifically is tied to the technology market and to chips and otherwise. So if you study that market, which we will do in shows to come, you'll see that it is really tied to the NASDAQ. But gold and silver run together at the end of the day. So I might say, okay, I'm going to take half my position, I'm going to put it in gold, I'm going to put the other half of the position in silver, but I'm not just going to select the underlying asset. I'm not going to go and just buy bars. I might buy some gold bars because I think it's always wise to have some physical assets on hand, but they're a little bit more of a pain when I go to liquidate, right? I got to go down to a dealer. I got to send them in to some of the shops online, JM Bullion or APMEX online. Those are two great dealers online that I've used in the past. I can ship it, but again, it's a hassle at the end of the day. Versus if I buy one of the ETFs out there, GLD or SLV, I can be in and out of my position in a nanosecond. The other thing I'm going to take a look at is what are the stocks? What are the miners that mine these precious metals? And what's the availability? Where are they trading? What's their PE ratios? What's their valuation? What's the potential upside? And we will give and name names in future episodes, but I want to encourage people to do your own research. You know, just listening to somebody and saying, oh, that sounds good, I'm going to go buy that. That's not going to develop you as a student. So go look up the miners. There's lots of ETFs. If you don't want to pick individual companies, you could pick the mining ETFs. Jay, you can talk about that here in a minute. But ultimately, I want to mix it up with a few stocks. Why? Because if I get this right, and there's going to be a run, which there has been a run, the stocks or the miners are typically going to outperform the underlying asset. What we're seeing right now is a little bit of an anomaly where the underlying asset is actually outperforming the miners, but that's typically at the beginning of a bull run. The last thing I'm going to encourage for people that feel as though they have a little bit more of a capacity, a little bit more advanced knowledge of the markets, is to consider some options. And you can look at call options. You can get more advanced with spreads and things like that. But if you're simply looking at a bull market run and you're looking at a 6 to 9 month runway, what are these in the money or out of the money options look like as part of that $100,000 that you're going to put into play? I would suggest a very small fraction of your money that you're allocating towards the options, but to give you some context, because we like to be transparent and share where we're at with our own trades, whether they're above water or underwater. The options that I have right now, I'm trading on SLV on the silver, and I've got $20 calls and $25 calls. Now, I've had these for 6 months, and some of them a little bit longer than that. So it was a lot of speculation 6 months ago that we're going to see a breakout. At the technicals that I saw, it was obvious that there's going to be some type of a move here. And so I put my money where my mouth was, bought at the time, in the money, $20 calls. Those are safer. And then it was out of the money at 25. Now I paid less than $1 for these. I paid about 50 cents for each one of these calls. And again, you want to pick up as many as you can, average your price, be prudent, use limit orders, et cetera, et cetera. Now today, those $20 calls are about $6, right? So I've done really well on those $20 calls. And those $25 calls on SLV are trading for about $2.50. It's about 5 times my money. Now, again, those are quite speculative. However, the underlying position that I have in silver, in gold, that has moved, it's been a good move. It's like 20, 25%. It's complemented by those options that are up 3, 4, 500%. So you don't have to put a lot at risk to have some significant returns. And as Gary said, I've taken a little bit, not too much, but a little bit off the table. So I'm playing with the house's money. I get my initial investment for those options that I bought. I go ahead and sell. When I see a big move, 3, 4, 500%, I'll sell just enough to cover my basis. And that way I'm letting everything else run. And if this thing falls apart in 2 weeks and I come back on our next show, I'm in tears. Well, I didn't lose any money. All my call options were paid for. So Jay, I want to hear your thoughts, building positions, the miners. What's your 2 cents on how to play this run?
Yeah, just to circle back what we talked about before real quick is selling something. A good rule is sell when you can, not when you have to, whether it's in the markets or real estate or wherever. That always comes to mind when we talk about selling. Going forward, kind of along the same lines, I've been faked out a few times over the last 3 years is the miners, following the miners. I like to get the juice out of the miners when the metals move because they do tend to outperform once things get going. But in some long-term accounts, I have it's an ETF that has the junior miners and junior silver miners. These are just the smaller companies that mine gold, and more speculative stuff. These would be smaller positions as far as your whole allocation is concerned. All your funds you're allocating to this sector. But I have some of my long-term account that actually were purchased a couple weeks ago when this started moving. And then I also have some in a shorter term account, which, like we're talking about, if you're trading around a bigger position, let's say you put your $100 in the long-term account, then I have $25 that I'm trading around in a shorter term account. But since we've seen the major breakouts that Andrew described earlier, for multi-year highs, and silver should catch up, I have faith in those longer term positions to hold, as long as they're still in the money, and they are. And at the same time, the fluctuations that'll happen from people buying and selling, and the activity that we have yet to see, there'll be more activity coming into this sector as more of the larger institutions become more friendly to it. There'll definitely be some fireworks going on. But I agree, if you have the ability or the competency to trade around a position, or to hold some long, and then trade around it, to do that. Otherwise, just allocate a portion of your portfolio to the metals, to the silver and gold, or they are moving, and it's just something that you can take advantage of at your own comfort level. But I focus mainly on the equities, and I think that stuff's just getting started. They do take a while to catch up, and we can probably, maybe not this time, but in the future, we can post some ratio charts showing in 2011, it took about 6 months before the miners and the junior miners blew past the return of gold. So gold was up 20% in the first 3 months. And then if you go out the next 6 months, the miners will be up, 40, 50%, and gold still up 25%. So you can take advantage of some leveraged growth on the miners, or the companies that actually do the mining of the metals.
Yeah, let's talk about ratio charts for a minute, because I think it's important, as Gary alluded to, what are these sell signals? Now, in the stock market, we can look at 52-week highs, 52-week lows. We can look at oscillators. We can look at so many different metrics that give us some indication that we're either overbought, oversold, at a turning point, if you will. But what I love to look at is the ratio charts. And as Jason just alluded to, there's ratio charts between gold and silver, for example. And that's one I study heavily, because when those two get out of whack, that's either a buying or a selling signal. For example, if gold, which historically has traded between 60 and 80 times silver, if it's in that range, that's fine. That's normal. But for example, in 2008, we saw that go to almost 100, meaning gold was trading 100 times what silver was trading at. So that marked, in my view, a top on gold. And if you had sold gold in the summer of 2008, you would have done well. Conversely, silver in the summer of 2011, when it went on its run to 50, it was only trading at 30 times the price of gold. So in that case, yeah, it looked like silver's definitely hitting a top here, because that is out of whack with the historical norm. In 2020, gold went to 120 times silver. So not only did I feel like that was a temporary top, that was actually a buy signal for silver for me, because it's out of whack with gold. And here today, we're in that range. We're at about 83 today. But you can run these same charts for the dollar and gold, the dollar and silver. You can run it for the junior miners, whether it's gold, GLD's ETF versus the junior miner ETF. And there's ways to just compare and take a look at the technicals to see, is this normal? Is this price action normal? And what technical analysis has done for me in my career is it's taken all the emotion out of trading. It used to be really exciting, right? Day trading and going overnight positions and feel like you're calling a baseball game, right? And the scoreboard and all this stuff. Yeah, well, take a few haircuts and lose a big chunk of change, and not so fun anymore. So the technicals, they bring everything back to, here are the facts, here's what's happening. The market's speaking, this is what it's saying. As I suggested earlier in the show, It's like watching paint dry, right? When you really get into it and you take the emotion out of it, it's a little less exciting, and you really are just watching kind of an evolving organism paint its chart as it goes, and you are measuring the human psychology, the human behavior of supply and demand, whether it's rational or irrational, and it will give you those indicators that lead you and help you to make decisions to buy or sell.
Indeed, I like to say too that people want to be in the know, but everything that anybody knows at any given time is represented in the price of that commodity or stock that you're looking at. Otherwise, it wouldn't be trading there. So that's why technicals are so powerful.
Right. Not to ignore the fundamentals. Fundamentals are important too, especially when we get to underlying stocks. As Jason was saying, trading the junior miners underlying stocks, there's going to be a lag period. And the reason for that is right now, we're guessing what their quarterly returns are going to be, right? Based on the new price of silver and gold. So we're forecast, everybody knows it's going to be better than it was this time last year, quarter over quarter, but we don't know exactly what it's going to be because we don't know their operations. We're not an insider at that company. So we have to make speculations and drive up the price as investors. Now, once they start to post these quarterly earnings and they can start to give guidance on, wow, yeah, with the new price, we did this, we hedged, we, started mining more, we opened up a new mine, we bought another mine, then it starts to look like, okay, this is really going to run. And you can see those miners on, say, a 20-30% move in gold and silver end up moving 2, 3, 400%. And you get a nice, pop in 2, 3, 4x on your investment. That is not the case with the underlying commodity. If you can get a good bull run of 30, 40, 50% in silver and some of the other smaller, metals and other commodities, 100%. I mean, that's historically, that is unheard of. So I would say clear the deck, take a lot of profits because you just experienced a once in a generation bull market run in the underlying asset. But with call options, with underlying stocks, they can run. I mean, go do your research. You'll see. In my position that I described earlier, I also built in 2 silver stocks. And so far, I'm up about 50, 60% on one, and on the other one's about 30%. It's lagging a little bit. Now, before the run, I had to stomach about a 30, 40% decline. So this is not for the faint of heart. This is not something you're going to be able to just pop on and watch the run. You're going to have, if you're going to trade in some of these markets, you're going to have the stomach to go through and the capital, the longevity to go through some of the initial cycles before the breakout. Now, Gary, hearing all this, because I know your background's in real estate, I'm so amazed that you stepped in as aggressively as you did with the metals, and proud of you because now you are a believer, you're a witness to the power of commodities when real estate's getting clobbered. Stocks have had a great run. If you're in tech and AI, you did well, but other than that, your other stocks have probably been clobbered if you're not in the Magnificent Seven. And so, yeah, what's your suggestions as we wrap up here towards listeners that are thinking, I've always wanted to own some gold and silver, and please don't buy those coins off the late night TV commercials, right? I mean, please don't do that. Be a professional. Get on some websites. You got AppMax, JM Bullion, if you want the physical asset, or get into the markets. With these ETFs we're talking about. But what's your suggestion for those first steps?
Yeah, well, we're here in San Diego, and I'm sure people are going to be listening all over the United States. But I found a local gold and silver outlet here and interviewed several and ended up creating a relationship with them where I could actually call them on the phone and say, hey, this is what I'd like to buy today. Okay. And they'd say, great, bring a check by in the next couple days. And, we'll save it for you at that spot price. So I think it's you don't want to just go out and start buying something that you're really not sure what you're buying. Yeah, you can buy some eagles and all sorts of different coins, and they come in bars where you can really get a great deal on silver. Go have a relationship, meet some of your local vendors in the town that you're in, and start a conversation and go in there and talk to them. Just like you're going out looking at homes, right? It takes time to find that first investment property. So you're not just going out and just, okay, hey, this one looks good, I'll buy that. Create a relationship with your local vendor and talk to them and see what people are buying, see what people are trading.
Yeah, and my suggestion for the armchair investors who are out there, I consider myself one of them, right? Don't want to leave the house. I want to be able to click a button and have things arrive at my doorstep. There are two great sites. I put them in the show notes. I've mentioned them a couple times now. And there's others out there. You just want to be careful, right? Because in this market, just understand that there's also shady operators. And so you don't want to be buying stuff that's discounted or scrap metal, or there is a spot price premium that you're going to pay if you're going to be buying physical gold and silver. And so for that reason, I do suggest people considering the ETFs and otherwise, because if you're going to have to pay 15% over spot price, your entry price is going to be higher than if you were to just simply pick up the ETFs. With that said, there's also the shipping, the storage. If you're going to be doing this through your self-directed IRA, most likely you're going to be with a company that provides storage. But for example, for my kids, right, I've got a son, a daughter, a wife, all four of us have our own accounts, and we're all paying storage fees. And when you talk about $150 per year per account, all of a sudden I'm at $600 just in storage fees. In addition to that, if you're going to take on the physical asset yourself with after-tax dollars, where are you going to store it? It's going to go in a safety deposit box, factor in that cost at a bank, or are you going to bury it in the backyard, right? I mean, there's people that do that, believe it or not. So whatever that is, just understand the transactional costs, because the transactional costs in this specific market can really eat you alive. And also understand the tax consequences when you're trading precious metals. It is no different than other asset classes in the sense that you do need to report it and you do need to pay the tax on the gain. And if you buy from a reputable dealer, you will be receiving, especially if you bought and sold through that dealer, you're going to receive those tax forms that you're going to need to pass on to your accountant. Jay, any thoughts as we wrap up? I mean, there's so much to dive into. I wanted to focus just on gold and silver because it's what's hot right now. And we will circle back with the other metals and go deeper with some of the other earth metals that are very interesting right now that are expanding in future episodes. But specific to gold and silver, somebody just getting started or somebody that's built up that big position looking, is now the time to sell? What do I do? How do we place their fear and their kind of calm that anxiety in the midst of a bull run?
Yeah, for those getting started, you can always start small. That's a good way it's your comfort level. So just invest what you can fall asleep with comfortably in whatever you're investing in. But as we were talking about the time frames, gold and silver, people have been waiting at least 5 years, if not 10 years, for the moves that are going on right now, and they don't happen often. And when they do, they don't last too long. So there's a window of opportunity. And for the folks that are in it now already, enjoy the ride. Sell when you can, not when you have to. I guess just look for some exhaustion. If you only have one friend talking about gold, as soon as you have three friends talking about gold, then maybe if you're trading, you can take some off the table. It's another way to think about it too. But definitely have some time, a couple years. I don't know what else is going to happen in the world at that time since gold and silver are moving how they are, but take advantage of opportunities when they're there. And yeah.
I love what you said about the social conversations. And when more people are talking about it, I can recall every deep stock market pullback when I was at the restaurant waiting in line or waiting to be seated, and everybody I can overhear their conversation is about the stock market.
Mm-hmm.
That's when I know we're done, right?
Mm-hmm.
We've hit either a bottom or a top, and everybody's freaked out, and the general public's talking about it. People that I know in my life that never track stocks are asking me what's going on with the stock market.
Right.
I know that we're hitting an inflection point. And so to Jay's point, the runs don't last long. in commodities. This is not stocks where you have 5 to 10 year runs. It could be the 1970s all over again, but that's the exception, not the rule. Typically, we look at 3 to 6 months of runtime, and then they're going to fade and go into their trading ranges because this is an underlying industrial asset at the end of the day. It's driven by supply and demand. It's different from stocks where people's emotions can get involved, or real estate where people's emotions can get involved, and people can just drive up the price based on unrealistic or unsustainable PE ratios in stocks, for example, or in real estate, unsustainable prices based on what the properties would eventually rent for. But with commodities, it's usually short and sweet. So I would just encourage everybody, don't fall in love with the commodity. Know that if you got to run, you've been blessed, take some off the table, enjoy it. If you're holding long term, that's fine. You can have that hedge. But when the market rewards you, there's no problem taking profit off the table, paying those taxes, and then you're in position with that dry powder, that ammunition you're going to need when the next market opportunity presents itself, whether it's in real estate, in bonds, or otherwise. So I want to thank everybody for joining us today as we move forward with our Real Cash Flow series. Prepare yourself, open up your mind, and be ready for the different asset classes as we go deep and we start to help you to park your money with where it's hot and where it's not. Have a blessed week, and we will catch you next episode.